Tonight, the FDIC has issued an alert that every American with a bank account needs to hear. New rule changes are going into effect within hours, and if you have money sitting in an American bank right now, if you are a retiree living on a fixed income, if you have worked your entire life to save what you have, you need to understand exactly what these changes mean for your deposits, your protections, and your financial security before tomorrow morning. Welcome to Senior Secure Income. This channel exists for one reason: to protect the financial well-being of American seniors and retirees with clear, honest, and actionable information. Stay with me until the end, because the final rule change I am going to cover tonight is the one that most directly affects retirement accounts and pension deposits, and it is the one that the mainstream financial media is not explaining clearly enough. Let us start with what the FDIC actually is and why its rule changes matter so profoundly for retirees. The Federal Deposit Insurance Corporation is the federal agency that insures deposits at American banks and savings institutions. It was created in 1933 in the aftermath of the Great Depression, when thousands of banks failed and millions of Americans lost their life savings overnight. The FDIC's core promise to every American depositor is this: your money is safe up to the insured limit even if your bank fails completely. That promise has held for over 90 years. Not a single depositor has lost a penny of FDIC-insured funds since the agency was created. That record is one of the most important pillars of financial security for ordinary Americans, and particularly for retirees who depend on their savings for daily living expenses. But that protection has limits, and those limits are changing, and understanding exactly how they are changing could be the most important financial information you absorb this year. Let us go through the specific rule changes now in effect. The first and most significant change involves the restructuring of deposit insurance coverage categories. For years, the standard FDIC insurance limit has been $250,000 per depositor per insured bank per ownership category. This means that if you had $250,000 in a single account at one bank and that bank failed, you would be fully protected. But what most people do not understand is the ownership category component of that rule. Different types of accounts are treated as separate categories for insurance purposes: a single account in your name, a joint account held with your spouse, a retirement account such as an IRA, a trust account. Each of these categories carries its own $250,000 limit at the same bank. The rule changes now being implemented modify how certain account categories are defined and calculated for insurance purposes. Specifically, the treatment of trust accounts is being significantly restructured. Under the previous rules, trust accounts received insurance coverage based on the number of beneficiaries named in the trust, up to a maximum of 5 beneficiaries, with each beneficiary receiving up to $250,000 in coverage. This meant that a trust account with 5 beneficiaries could receive up to $125 million in total FDIC coverage at a single bank. Under the new rules that are now taking effect, this calculation method is being simplified and in many cases reduced. The new approach caps trust account coverage at $125 million per owner, regardless of the number of beneficiaries beyond 5. For trusts with fewer beneficiaries, the per-beneficiary calculation still applies, but with new documentation requirements that did not exist before. And for many retirees who have set up revocable living trusts as part of their estate planning, these changes mean that the coverage they believed they had may be different from the coverage they actually have under the new rules. This is not a hypothetical concern. This is a concrete change that affects real money sitting in real accounts right now. What should you do immediately? Contact your bank and request a detailed breakdown of your FDIC insurance coverage under the new rules. Ask specifically about any trust accounts, joint accounts, and retirement accounts you hold at that institution. Do not assume that the coverage you had yesterday is the same as the coverage you have today. Banks are required to provide this information, and their staff should be able to explain your coverage clearly. If they cannot, ask to speak with a senior banker or contact the FDIC directly through their online estimator tool called ED, which calculates your coverage based on your specific account structure. The second rule change involves the treatment of retirement accounts and pension deposits under the new FDIC framework. This is the area that matters most to the audience of Senior Secure Income, and I want to be very precise here because the details matter enormously. IRAs, both traditional and Roth, have always received separate FDIC coverage from other account types at the same bank. Under the existing rules, IRA deposits at an FDIC-insured bank receive up to $250,000 in separate coverage. This rule is not changing. Your IRA deposits remain separately insured up to $250,000 at each insured institution you use. But here is what is changing and why it matters for retirees specifically. The new rules introduce stricter requirements around how banks must document and verify the retirement account status of deposits in order for those deposits to qualify for the separate retirement account coverage category. If a bank's internal records do not correctly classify your IRA deposits as retirement account deposits under the new documentation standards, those deposits could be grouped with your other personal deposits for insurance calculation purposes rather than being treated as a separate category. In plain terms, if your bank makes a documentation error under the new rules and you have more than $250,000 combined across your regular accounts and your IRA at the same institution, a portion of your deposits could be uninsured without you knowing it. Not because the rules do not protect you, but because a paperwork failure at the bank level could misclassify your accounts in a way that reduces your effective coverage. The protection against this scenario is simple but requires action on your part. Request a written statement from your bank confirming how your accounts are classified for FDIC insurance purposes. Verify that your IRA is correctly identified as a retirement account in the bank's records. And if you have total deposits at a single institution that approach or exceed $250,000 across all account types combined, consider whether spreading those deposits across multiple FDIC-insured institutions would give you more comprehensive protection. The third rule change involves new requirements around the disclosure of FDIC insurance information to depositors. Banks are now required under the updated rules to provide clearer, more prominent, and more frequent disclosure of FDIC insurance coverage information to their customers. This includes updated signage at branches, updated language on account statements, and new digital disclosures for online banking customers. On the surface, this seems like a straightforward administrative change, but there is a deeper implication that every depositor should understand. The reason the FDIC is requiring more prominent disclosure is directly related to the confusion that emerged during recent bank failures, including the collapse of Silicon Valley Bank and Signature Bank in 2023. During those events, a significant number of depositors discovered for the first time that their deposits exceeded the insured limits and were therefore at risk. The panic that followed contributed to the speed and severity of those bank runs. The new disclosure requirements are designed to ensure that depositors are aware of their coverage limits before a crisis occurs, rather than during one. For retirees, this is particularly important. Many seniors have accumulated savings over decades and may have total deposits at a single institution that they have never thought to compare against the FDIC coverage limits. A retiree who has $400,000 in savings at one bank may believe their money is fully protected when in reality $150,000 of it is uninsured if all of those funds are held in a single ownership category. This week, before you do anything else financially, take 30 minutes to review your deposits at every bank you use. Write down the total amount you hold at each institution. Break it down by account type: single accounts, joint accounts, IRAs, trust accounts. Then use the FDIC's ED tool online to calculate your actual coverage. This exercise takes very little time, and the peace of mind it gives you, or the action it motivates you to take, is worth every minute. There is a reality about financial security in retirement that I want to name directly and without softening. The financial system that most American retirees depend on is more complex and more subject to change than most people realize. Rules that seemed settled and permanent get revised. Coverage that seemed comprehensive has limits. Protections that seemed automatic require documentation and verification to function correctly. This is not a reason for panic. It is a reason for informed, proactive engagement with your own financial situation. The retirees who are most financially secure are not necessarily the ones with the most money. They are the ones who understand the rules that govern their money, who verify their protections regularly, who ask the right questions of their banks and financial advisors, who act on information like what I have shared in this video before a crisis makes action urgent and difficult. You worked your entire life to build what you have. You deserve to know that it is protected, fully, correctly, under the rules as they actually exist today and not as they existed years ago when you last checked. That is what Senior Secure Income is here for. Every video on this channel is designed to give you the knowledge you need to protect your financial future with the seriousness and the respect that your lifetime of work deserves. If this video helped you, hit the like button right now and share it with a fellow retiree or someone approaching retirement who needs to hear this tonight. Leave a comment and tell me how much you knew about FDIC coverage limits before watching this video. I read every comment and respond regularly. And if you are not yet subscribed to Senior Secure Income, subscribe now and turn on the notification bell. Because in the coming days, we are covering more critical updates on Social Security, Medicare, pension protections, and retirement financial rules that every American senior needs to know. See you in the next video.